If you are holding out for mortgage rates to drop, you might be in for a long wait. Rates are climbing once again, catching many home buyers off guard. But what if I told you that inflation and job growth are major reasons why your dream home has become more expensive? In this video, we'll break down why mortgage rates are rising even after the Fed lowered interest rates and what this means for your next steps in the housing market. Just 1 month after the Federal Reserve lowered its benchmark interest rate by 0.5 percentage point, the first cut since 2020, the 30-year fixed-rate mortgage rose for 3 consecutive weeks, jumping from 6.09% to 6.44%. While still below the October 2023 peak of 7.79%, this sudden increase surprised many, raising concerns among potential buyers who've been waiting on the sidelines. How has this rise in interest rates impacted your plans for buying a home? Drop your thoughts in the comments below. I'd love to hear them. So why are mortgage rates climbing again, even after the Fed cut rates? To answer that, we need to understand the role of the Federal Reserve and how it influences the broader economy. The Federal Reserve, or often referred to as the Fed, is the central bank of the United States. It has 2 primary goals. 1, promoting maximum employment, ensuring as many people as possible have jobs. And 2, maintaining price stability, keeping inflation near its target of 2%. When the economy grows too quickly, the Fed steps in to cool things down. This is to prevent the economy from overheating, which can lead to inflation. But what exactly does overheating mean? It's a term I know that gets tossed around a lot, so let's clarify. An economy is considered overheated when demand exceeds supply, and this can lead to several key problems. First, rising inflation. When demand for goods and services outpaces supply, businesses increase prices, leading to inflation. Inflation diminishes the value of money, making everyday items more expensive. Think of inflation like a balloon. You keep blowing air into it, and if you don't control the flow, it eventually pops. The Fed's role is to ensure we don't pump too much air or money into the economy too quickly. Second, labor shortages and wage pressures. In a booming economy, companies may struggle to find enough workers. This drives up wages, which sounds great. But if wages rise faster than productivity, businesses face higher costs, pushing prices up even more. Third, asset bubbles. Overheating can also inflate asset prices like stocks or real estate beyond their real value. When these bubbles burst, they can cause significant financial damage. So what tools does the Fed use to cool the economy? There are 3 ways. 1, reducing the money supply. By tightening the supply of money, the Fed makes borrowing more difficult, slowing economic growth. 2, adjusting fiscal policy. Sometimes government spending or taxes are adjusted to limit money circulation and cool demand. 3, raising interest rates, the Fed's most common approach. When interest rates go up, borrowing becomes more expensive, reducing consumer spending on things like homes and businesses. This helps to slow inflation, and that's exactly what the Fed did over the last years. Now, it's worth remembering that the Fed originally cut rates in 2020 to stabilize the economy after the COVID-19 pandemic hit. However, in recent years, the Fed reversed course and started raising rates again to combat rising inflation. Think of the economy as a house with the Fed controlling the thermostat. When things start to heat up, meaning inflation is rising, the Fed turns down the temperature by raising interest rates. This slows things down, much like cooling off the house. But if they cool it too much, it risks freezing the economy. So why did the Fed raise rates post-pandemic? Well, there are several reasons for the rate hike. 1, rising inflation. After the pandemic, the economy rebounded super quickly, fueled by stimulus and pent-up demand. But supply chain disruptions, you all remember that, led to shortages, which in turn pushed prices up. High inflation erodes purchasing power. To bring inflation under control, the Fed raised rates to make borrowing more expensive, which reduced overall demand. 2, avoiding a wage price spiral. If wages rise too quickly, it can lead to higher prices for goods and services, creating a cycle of inflation. The Fed raised rates to prevent this. 3, restoring price stability. Price stability is the Fed's core mandate. As inflation surged after the pandemic, the Fed acted decisively to prevent it from becoming entrenched. And 4, preventing long-term economic damage. If left unchecked, inflation can reduce consumer confidence, lower investment, and create financial instability. By raising rates, the Fed aims to avoid these long-term consequences, even if it means slowing the economy in the short term. Now let's connect this back to mortgage rates. Many had hoped that the Fed's rate cuts would lead to lower mortgage rates, and for a while they did. However, the recent rise in mortgage rates shows that while the Fed has influence, it does not directly control these rates. The Fed's policies impact the broader economy, including treasury yields and credit costs, which influence mortgage rates. But there are other factors at play, like inflation expectation, demand for mortgage-backed securities, and the overall economic outlook. So while the Fed is a key player, it is not the only one. So why exactly are mortgage rates rising again? Aside from the Fed's actions and inflation, the job market plays a crucial role. Let's take a closer look at how employment ties into raising rates. A stronger than expected jobs report in September 2024, along with higher than anticipated inflation at 2.4%, are major reasons behind this uptick in mortgage rates. Let's tackle the stronger job market. When more people are employed, consumer demand rises and lenders anticipate higher demand for mortgages. To balance that with inflation risks, they raise rates. Now how about rising inflation? Even a slight uptick in inflation like 2.4% signals stronger price pressures. Lenders respond by increasing rates to protect against the erosion of the future value of mortgage payments. When inflation rises, the money lenders receive from fixed mortgage payments loses value. To compensate for this, lenders raise rates to maintain profitability over time. Next, the bond market reaction. Mortgages are long-term loans, typically 15 or 30 years in duration. The 10-year Treasury yield is a benchmark for long-term interest rates, including mortgage rates. While mortgages aren't directly priced off the 10-year yield, they tend to move in tandem because both are long-term financial products with similar risk profiles. Investors look at the 10-year yield as a proxy for longer-term financial trends and risks, making it a key indicator. So when inflation and job growth exceed expectation, bond yields rise and mortgage rates follow suit. Finally, speculation about the Fed's next move. A strong job market paired with raising inflation lead to speculation that the Fed could halt rate cuts or even raise them again, pushing long-term rates, including mortgage rates, higher. In conclusion, as we've discussed, there are many factors in play in determining mortgage rates, so predicting mortgage rates is tricky. Most experts agree that we're unlikely to see rates return to the historically low levels of a few years ago, creating uncertainty for home buyers. Now I know for many, buying a home is one of the biggest financial decisions of their lives, and rising mortgage rates aren't just numbers. They could mean the difference between achieving a lifelong dream or staying on the sidelines. It can be tough deciding whether to wait for rates to drop or jump into the market now. Most experts advise against trying to time the market. If rates fall later, you can always refinance, but if they rise, buying could become even more challenging. Historically, home prices tend to rise over time. Even buyers who purchased at higher interest rates have seen gains from rising property values and refinancing opportunities. So if you are a prospective home buyer, what's your plan? Will you buy now or wait for rates to drop? Or are you already a homeowner concerned about how rising interest rates might affect your home value? While it's easy to assume rising rates will lead to a housing market crash, history suggests otherwise. For example, in the 1980s, mortgage rates soared to as high as 18%, yet home prices continued to climb in many areas due to strong demand and limited supply. Similarly, in recent years, even as rates increased, housing prices remained resilient thanks to factors like low inventory, a strong job market, and demographic trends driving demand. So this concern is not necessarily warranted. Hey, if you found this breakdown helpful, be sure to subscribe. Your support helps us grow this channel so we can continue bringing you more educational content like this. Thank you so much for watching.